All right. How's everybody doing? See if I can get this thing to come up on the screen. I'm having a little technical difficulties here, as usual. All right. How come this won't fit on the screen? How come it won't go on the screen? There we go. All right. How's everybody doing this morning? It's good to get started. Nice to see you guys all here. Got a nice little crowd. First thing here in the afternoon. We got 1 hour until the market closes, and we're going to do a little bit of day trading. We're going to do a little bit of day trading, but we're going to do it with options. All right, so we're going to play with options, a 0 DTE, 0 days till expiration. So generally, we talk about options where we're like, okay, how long before this option expires, right? It's like earnest money on a housing trade, right? So I'm going to bring this over here. There we go. And or on a house that we're going to buy. So we go buy a house and we got earnest money. Generally, that's I don't know. When I bought houses, they generally give you three months, right? So that's your days till expiration, your option. Earnest money is nothing more than an option on a house. You have the right, but not the obligation to buy the house. If you don't buy the house, you lose the earnest money. Same thing as an option. That's all an option is. It's just earnest money on buying a stock. Now, the difference between a house over in the real estate industry and an option in the stock market is that in the real estate industry, we don't generally buy and sell the earnest money, right? We don't trade the earnest money. We don't go in and say, I'm going to buy this house, put a 3-month earnest money on it, wait for the house to go up in value, and then trade the earnest money. But that's what we're doing in the stock market, because stock markets are a lot more volatile than a house. So if you're going to trade just the earnest money on a house, you'd probably need several years of earnest money, right? Because wait for the house to go up and down in value, not really take control of the house. Not that somebody would even let you do that in the real estate industry, but we do it in the futures market, in the stock market all the time, right? You can buy an option, which is just earnest money on a stock, and then wait for the earnest money because the value of the stock goes up and down in that short period of time enough that it would make the earnest money rise or decrease in value, because the earnest money on a real estate deal is generally based 1% of the house. So if you're going to buy a $300,000 house, they're going to make you put down about $3,000 to hold the house. That's your option that you would lose if you didn't perform and buy the house. So that's the same thing with an option in the stock market. It's just earnest money. That's all we're doing. We're trading earnest money. But because the value of the house itself, which is the stock, rises and falls, well, that 1%, that $3,000 over a 4-month period of time could increase to $4,000 or down to $2,000, right? It could go up and down. If you're going to go off of a 1% increase or decrease of value of the underlying asset, and that's just a rule of thumb, I'm just pulling out of my ear, but you get the idea. The concept is that earnest money could increase or decrease in value based on the 1% of the underlying stock. Houses don't generally move that much in that short period of time, but stocks do. So we don't generally say, well, I'm going to take possession of the house and wait for it to go up and down in value. With the stock, we don't have to do that. We just trade the earnest money, because the earnest money will go up and down in value. If you ever want to take possession of the house, well, you're going to have to come up with $300,000. Well, I don't have $300,000. I only have $3,000 that I put down as earnest money because I don't have any intention of ever taking and living in the house or taking control of the house. So in the real estate industry, we don't really do that, right? If you don't put earnest money down on a house if you don't really intend on taking it. In the stock market, we do. We come in and we say it all the time. Hey, I'm going to put some earnest money down to buy that stock because I think the value of the stock is going to rise before the earnest money is due, right? Before the payment of the house is due. So I can then liquidate, get rid of my earnest money, take the profit between the 1,000 that I put down to the 3,000 I put down and the 1,000 it rose. Now I got $1,000 in earnest money. I can get rid of I don't have to buy the house. I don't have to come up with the $300,000 for the house. That's all we're doing. It's the same exact story, futures versus stocks versus the real estate industry. All right. So when we come in here, markets can go up, down, and sideways. They can only do 3 things. How to directionally trade each move in the market. Rule of 3-3-3. Okay. You got a 33% chance when you get into the market, whether you're going to be right or wrong, because markets can do 3 things. If you say, well, I think the market's going to go up, well, you're only got a 33% chance of being right, because the market can go sideways or the market can go down. Well, I think the market's going to go sideways. Okay, well, you got a 33% chance of being right, because markets can go up and markets can go down. Well, I think the market's going down. Okay, well, you got a 33% chance of being right, because markets go sideways, markets go up. So when we trade, you look at these different ways of making money when markets are going up, down, or sideways. So markets can go up. How do you make money in a market that's rising? Well, you buy a contract in the futures market, you buy shares in the stock market, you buy a call option on any of the markets, or you sell a put option, right? If the market goes up, if you buy a put option, well, you lose money. So that in turn is just the opposite of that. If the market goes up and you sell a put option, well, you make money. So you got two sides to every option. And so that's the part that kind of confuses people. And that's why options become scary and hard. Oh, no, I don't understand it. No, it's just the very simple side of things. You make money. If you buy a call and the market goes up, you make money. If you buy a put and the market goes down, you make money. Well, the opposite side of that would just be the other side of the table. If you sell a put option rather than buy it and the market goes up, well, you're going to make money. Pretty simple. All right. The market's going to go sideways. How do you make money? Well, the only way you make money on a sideways market is you sell a call option or you sell a put option. And why do you make money by selling a call or selling a put if the market goes sideways? Because you get to collect the premium every week, right? Every month, every day, throughout the period of time that you own it. That's how you make money on selling options, that you get to collect the premium that the guy who bought the option has to pay every day because the market's not going up or down. So he's losing money every day, time value, right? Because we have to divide the amount of time that we have left in the option by the amount of money that we spent for the option. Therefore, every day you have less time. Therefore, you have less value in your option. Therefore, who gets that value? Well, the guy who sold it to you. That's why you sell options, is to collect that premium every day. It's kind of like an income source. Problem is that they have unlimited loss potential. If the market takes off and goes to the moon, well, the guy who bought the option, he gets to make all that money. Well, who has to pay it to him? Well, you do. You have to pay it to him because you have unlimited loss potential. He has unlimited profit potential. And if you sold him the right, well, you're the one that has to pay it to him. All right. So same on the downside. How do you make money when the market goes down? Well, you sell short, contract a future, or sell a short shares of stock, or you buy a put option or you sell a call option. That's all there is to it. It's just the other side of the trade. Just the same thing as if the market goes up. It's just if the market goes down, that's how you do it. You sell a contract, you sell some shares, or you buy a put option, or you sell a call option. If you sell a call option, well, and the market goes down, you got to keep the premium, right? You don't get to make a whole bunch of money. You just get to keep the premium. But that's making money. That's how you make money if the market goes down. You have limited profit potential, but you have unlimited loss potential. But if the market goes down and you sold a call option, well, you get your profit. It's limited. It's limited to the amount of premium that the guy who you sold the option to has to pay for it, but that's your profit. That's what you do it for, right? So markets can only do three things. They go up, then go down, then go sideways. And this is the way you make money depending on what direction you think the market's going. That's why it's very important. One of the most important things I can teach you is how to read a market. How do you know whether a market's going to go up or down in value? And we talk about this endlessly, incessantly, right? We talk about all of these reoccurring price patterns, how we try and determine whether markets are going to rally or fall based on probabilities. We talk about probability tables. We do strategies to try and help us determine all this stuff, right? We have all these little wonderful tools that help us decide whether markets are concave or convex, or whether they're going to do an intercept order for a reversal pattern. We talk about endlessly about how to determine whether markets have a probability of being in the 1 standard deviation, the 2 standard deviations, the 3 standard deviations. These are all things that we cover in this class. We talk about endlessly, right? So this is why it's important to understand all the ways of determining the market direction, because you make money on knowing and determining the market direction. You're like, well, I want to not have to pick market direction. Okay, well, you're still, by not picking market direction, you're still picking market direction. I'm not going to pick market direction. I'm going to make money without picking market direction. Okay, well, then you're picking market direction by saying I'm not going to pick market direction. You're going to say, I think markets are going to stay neutral. Okay, well, if that's the direction you picked, that they're not going to go anywhere, then you got to make money on that. Because then if they go the other direction, and they actually do go the direction that you didn't think they were going to do, or that you're playing against, you either make or lose money that way too. So the whole name of the game is picking market direction. And if you're not into picking market direction, this is not the game for you. Because it doesn't matter. I don't care how many guys tell you, oh, you don't have to pick market direction. Bullshit. You have to pick market direction. Even if you don't have to pick market direction, you're picking market direction. Okay? So there's lots of strategies in the options world where they say you don't have to pick market direction, but you still have to pick market direction. Which market direction do you want to pick that you don't want to pick? That's what you're picking. You're picking where the market's not going to go. You're not going to pick where the market is going to go. You're going to pick where it's not going to go. That's still picking market direction. I can show you a dozen examples where you don't have to pick market direction, but you still have to pick market direction. You don't pick market direction. You pick where the market's not going to go, not where it is going to go. Now, sometimes it's easier for people to look at a chart and say, I know where it's not going to go. I can tell. I look at a chart. I know where it's not going to go. It ain't going there. Okay, well then put an order that makes money if the market doesn't go there. But you're still picking market direction. All right. So anybody who's out there selling you a bill of goods saying, oh, you can make money without picking market direction, call BS on them. All right. You still have to pick market direction. You're just going to say, I don't think the market's going to go here. Okay. Well, you picked a market direction. You just said it's not going here. So which is easier for you? You want to pick a direction or you want to not pick a direction? If you're not going to pick a direction, you don't make as much money as you do if you pick a direction. Just kind of the way it goes, generally speaking. If you're going to be very conservative, say, I just think the market's not going to go way, way, way up here. Okay, well, it's going to stay down here. Okay, that's fine. You're going to pick that, and you're not going to make as much money as if you were right to pick the direction. If you pick the direction and you're right, well, you make a lot more money. You get paid for being smarter. Okay. And being smarter is knowing which direction the market's going to go. Now, nobody knows which direction the market's going to go. So what we do is we do probabilities, right? It's all about building up a probability table. And so we want to know the probabilities of a market going, rising, and falling during a different time frame at any given place in the trend. We want to find out what those probabilities are. And that's what trading is all about. Whether you're trading contracts, shares, or options. Options is the same thing. You still have to pick direction. I know there's ways you can trade. I got to pick direction. Okay, well, you still picking direction. I don't care if you say it's a neutral options position. What you're doing is you're picking that the market's not going to move up or down. You're picking a neutral option position. That's still picking a direction, which is not a direction. Markets can only go three ways. They can go up, they can go down, or they can go sideways. And if you're not going to pick up or down, well, you're going to pick sideways. That's not picking a direction. There you go. That's how it works. Okay, so let's get down to business here. We're going to come in here. And today we're going to trade with a 0 DTE option. We come in here, we're going to trade the minis, and we're going to go to the S&P. And the reason we're going to use the S&P, we're going to do this in the futures market. And the reason we're going to trade the futures market, well, that's the March contract. That's the volume's fallen way off on the March contract. And that's the closest ones to expiration. We're going to go out to June, see how June looks. June looks good. All right, look at the S&P, flushing down like a toilet. All right, let's come in here. Let's get rid of March. We don't need that data streaming in the background. We're going to come in here and we're going to go down to just a 1 minute chart. How's that look? And it's only, I got 45 minutes till the bell rings. So we're not, they'll probably do a little bit better if we did this like in the morning. Maybe next week we'll do this in the morning, like next Wednesday, we'll do a morning session. All right. Because on Tuesday morning, next week, we're going to do a morning session. Wednesday, we generally do the afternoon sessions. But next week, how about next Wednesday? When we do the day trading stuff, we'll do a morning session next Wednesday, and then we'll so do 3 morning sessions. We'll do Monday, or not Monday, but Tuesday morning, Wednesday morning, Thursday morning. We'll do morning sessions. That way, on Wednesday, we'll do day trading, 0 days till expiration. We'll do day trading with options on next Wednesday. That sounds fun because I like to do that because options are a great way to day trade, believe it or not, because it takes a lot of the pressure off. So this is what the market looks like right now. What are we seeing? Well, you have to read the direction. Well, which direction is it going? Right. Let's come in here and turn off this auto scale. And so which direction did the market go today? Well, mostly it just kind of went sideways. It just kind of died all day long. There's the morning bell. And you can see the market kind of flushed down and then it just kind of rolled back. And then throughout the day, it just kind of went sideways, didn't do anything, had a little bit of a flush here. And then it kind of rolled back up, didn't really do anything. This has been a lousy day to take a position in the market, one direction or the other. And then it kind of here towards the end, starting at about, looks like noon, it started to roll over, started to come back down. Now we're getting a little bottoming pattern in here. If you just draw your trend lines, now notice that these dots that I've got on here are just mathematically calculated trend lines. And remember, there's one up for every down. And so it's just, you just draw your trend lines between these arrows. So you got one up, you got one down, you got one up, you got a little tiny down in here, you got another up right here, you got another down, a nice big down, a little up, a little down. And so this one here, higher highs and higher lows is the name of the game, right? So we got a high here, we got another high here, we got another high right in here, and we got another high right in here. But these are all lower highs. So if we come in here and we see that we got a low here, we got a low here, we got a low here, and we got a low here. Well, these are all lower lows. So definitely we're in a downtrend. But we could get a reversal right here because we've come down how many drives? We got one nice big drive here and another nice big drive here. So technically speaking, this would be X, 1, 2, 3. We just kind of got this nice little ABC pattern. Now it did a little flip-flop in here, which is not uncommon as we transition from one to the other, but that's just kind of an ABC pattern in here. And you can see that this market has just kind of gone from this A point up here, down here, pulled back a little bit, and then it fell back down in here. So that's an ABCD pattern down to the bottom. You can see it came down. If we kind of line these up a little bit more closely with the data, we kind of want to bring that over here to kind of line it up. We'll see where we can line that up. This B point needs to be at that data point right there. So right here is the low point of that between C and A. So right there, and I'm just trying to get it to be on that price level. So we're going to bring Brie, and it has to be on that price level. I was just trying to set it somewhere along that price level in there so that it lined up with this scale right here. So we see that came right down to 130.9, which is the golden ratio. So that's where we ended up. And now we're getting this little ABC pattern down here. Now, this little ABC pattern, the test for this, another little ABC pattern, is this low right here. Is it going to give us another lower low, or is it going to stay above that low and turn around and start to go back up and turn into a bull pattern, a bull market? Because that would give us an indication the market's changing from bearish to bullish, right? So we got to watch this right here and say, is it going to break and make a new lower low? Because if it does, well, we're still in the downtrend and we'll get a third drive. So this is drive 1, right? This is drive 2. If it goes down, that would be drive 3. And then that would be a full Elliott wave, and we'd be at the bottom of the 3 standard deviations. So remember the 3 standard deviations, that's this window here. So the 3 standard deviations, the center point is this on the retracement, but we're coming down 1 drive, 2 drives, 3 drives. So we get 3 drives outside the standard deviation, which is what this little delta cone of probability is all about. And so that's going to tell us we're way down here in the 3rd standard deviation. If it goes down and breaks that, we're probably not going to get a little ABC and go into a 4th standard deviation, which would be a 4th drive. Drive 1, drive 2, drive 3. It's rare to go into a 4th drive. Doesn't mean it can't. Certainly can. Just really rare. See, it's 99.7% of the time it falls within 3 standard deviations. That's what that cone of probability tells us, or the empirical data distribution rule. So if that's the case, then we're getting down there. We're getting down there. It doesn't mean it can't go to 4 drives. Certainly can. But we oftentimes see it end right here at 3 drives. Let's see if it goes down and breaks this. Sometimes stupid markets, they do what they want to do, believe it or not. They'll break it just to prove that they can, and then they'll take off. That's called the Wyckoff spring. And they do that on purpose just to show you, hey, we can break into that 4th standard deviation just to prove that we can. Now here we'd be coming down into the 3rd standard deviation. So it would do that without a problem. It can do that, not break any rules. So let's wait and see. But if it turns and starts to rally right here, see, it's going to cross those little yellow dots. That would be a place to get into this market. Let's go ahead and delete all of these drawing tools. And this would be a place, because our big test right now is just this low right here. Is it going to break that low, or is it going to turn and start to go green and rally once again and start to come up out of there? We don't know. That's why it's great to use an option. How would we do this? We come in here with an option. And the reason you're using the S&P 500, because the S&P has good options. The NASDAQ, the Dow, the Russell, they don't have good options over here in the S&P 500, okay, or over here in the futures market. So they don't have good options. Oh, we're still kind of wait for a second. Now, what we could do is we just come in here, and if we think the market's going to go up, we could buy a call. That's all we have to do. Now, that's a 13-day call. We don't need a 13-day call. We can use a 2-day call, all right? So we can come in here, and we could just put that in there, and if we think the market's going to rise, we could put that in there. Now, that's going to cost us $2,400 to put that in there right now, but we don't need to do that. Let's just wait for a second and see what's happening. It's getting ready to turn around. We could put it in. No harm, no foul, right? We come in here and just drop this in here. And if it turns around and starts to go up, we'll have an option to going up. If it goes down and breaks it, we could just get rid of it, take a small loss. So let's come in here and anticipate that it's going to turn around and start to go back up. So I'm just going to mark it in for it, see if it'll mark it in. Okay, we got a long position right now. Just in case it turns and starts to go back up, we'll have that in there. Let's come in here and go to calls. Just going to do calls all by themselves. All right. If it goes down and breaks that, we'll just get rid of it. Take a small loss. So we're down $62. So, it'd be about the same as if we were trading the contract themselves. But it's kind of a soft stop. What if it does a spring and then goes back up? You're like, but Lan, you're losing money. Yeah, we're down $100 on our option. So we broke the low. So that means we should probably just liquidate it. Or what else could we do? You don't have to liquidate it. You come in here and buy a put. You could buy a put. Now the put, we put a put in here. It's going to cost us $2,587 to put that on. And that'll make money as the market goes down. Let's market that. You can just watch what both of them do. Okay, so now we got a put, makes money on the market down. We got a call, makes money on the market up. So we got one of each. This is called a spread. It's called a strangle. This is a straddle. This is a strangle. Okay, so our market's actually trying to turn around and go back up. So I didn't get rid of the call one yet. Because what if the market did this? What if it went down a little ways? We made some money on the call and then turned around and went back up. Then we could make money back on our call. Oh, look, it's turning around. The call's making money. Let's come down here to our accounting. You can see over here, I'm in the way. Let's get out of the way, Lan. Let's bring this up. All right, we're just learning here. This is a demo account. We're not doing this with real money. We're practicing. See what happens. That's how you do it. What happens if we put a put option on? What if we had a call option on here and we didn't want to sell it? We put a put option on. Well, you make money on the put if the market goes down. You make money on the call if the market goes up. So if the market goes down for a little ways, well, make some money on the way down. It's going to make about as much money as you're losing up here. And then what if it turns around and starts to go back up? Well, you still got your call. You just take off your put and let the call make money. It's like being long and short at the same time. The neutral. It's a neutral option strategy, right? We paid a pretty wide spread on this thing. 2 days till expiration. 2 days till expiration means they're going to hang on to their premium quite strongly. On Friday, we could have a 0 days till expiration, but today we got 2 days. It's Wednesday. So these options are going to expire on Friday. You could hang on to them overnight too if you want to. There's no overnight because you bought them and you paid $2,400 here and $2,600 here. You got no margin requirements because you're just buying. So if you can afford it, buy it, and then you can hang on to it. It's good for 3 days. Not changing much, is it? Seems like it should be changing. How come we're not updating our data? Our options are not closed. Options chains. I get so many things going on the internet. I need faster internet. Let's come back over here. Oh, they're changing. Let's go to our accounting and see closed positions. These are not, oh, there they are. They're changing. They're ticking along. Okay. So where's our put? That's our put right there. Okay, our put's up down $37 still, it says. Our call is losing 125 because the market keeps falling. We put it on right there at the bottom. We should have just pulled that off. But we're not making any money on our put either. We could do this. Let me show you something else I like to do. This is just buying puts and calls. I like time to go away. So we can come in here. We can actually sell a call. Now, if we sell a call up here, we have a call. We could sell a call right here. Let's sell a call at the same place we got that put. We're just going to sell one. And we're going to go market into that. The market keeps falling. Now it's turning around and come back down. Did it market in? Did it let us in? What did I do? If you sell, then your premium just keeps decaying. That's one thing I like to do on day trading with options, is you just sell. But we could do that next week. I wanted to buy this time. We'll sell next time. Well, we can sell today too. See if it's going to let us have it. There we go. Now we sold a call. We bought a call here. We sold a call here. So now if the market keeps falling, this call will lose money. This call will make money, and the put will make money. So we're double short. There's the short one right there. We paid a $37 spread. Ugh. All right, let me see. I'm still in the way, aren't I? They're going to put me over here. If I do that, then I can come down here. All right. Trading options a lot slower. That's why I say you probably kind of want to do it in the morning when you got more time. Doing it right here at the end of the day. I like to do it when I do it at the end of the day with options. I like to just sell the option and let the premium decay, usually with a 0 days till expiration option, which would be Friday. And then that option decays really fast towards the end of the day, and the market move against you still almost can't make up for it. So I like to sell options on 0 days till expiration when you're day trading. We're not getting much movement on these things because they got 2 days till expiration. We're trying to do something here in 30 days, 30 minutes. We're not getting much movement. Our short call is losing money. Oh, the market's coming back. So our long call should start making money. And that stupid put option didn't move at all. It's like it's stuck at 137.50. And that was the spread. We had a bit more of a spread than that. I don't know. These are moving pretty good, but that put option is stuck. Like it's not changing at all. I don't know what's wrong with it. It says it's moving, but I'm not getting any movement down here. Up here, it says we're down $37. Down here, it says we're down $137. I don't know what's wrong. I'm not getting, I need faster internet. All right, well, this says we're at 37. Let's go off these numbers up here because these seem to be moving and the ones down in the counting window don't. 37.50. So we're down 37. This one's down 87. This is down 137. But it's starting to come back. It's going to give us 2 bars and then flush again. They're going to go up 2 little green bars and then flush. Man, alive, my computer is so slow. Come on, baby. Make a decision. We want it to go down, actually, because we'll make more money if it goes down. That put option is not changing down here at all. We're not getting any updates on our put option in accounting. It's changing up here. Look. Which is which? Page 26. The put is this one down here on the bottom. Buy one put. So that's this one. So we're only down $37 on our put. The market's coming back against us. So this one's going to start to reverse and go the other way. We got a put and a call right at the same spot. We sold a call and we bought a put right at the same spot, just to see what happens. You guys have any questions? You just having fun watching. I wish they were 0 DTEs, because then they would be more sensitive to price. We have more fun. Not doing a whole lot right now. Everything's down. Everything's down. I want to see this come down a little bit more and then bottom out. Look at our MACD. It's turning already. It's gone green. But this bar is coming down. So as it comes down, these two options right here should start making money. We're down 37 here and 37 on that one, which sell a call, buy a put. Oh, that one is moving. It's just buy call. The buy call is the one that's stuck at 137. That's the one up here. Oh, and it is 137. That's the one that's stuck, not moving. These two are moving. Okay, as the market falls, those two should move in our favor, both of them. The call is on top. This is the call we sold. We're only down $12 now. We're getting up some of our spread back. That call option up there is just sitting there at $137 down. Oh, the market did a spiky dikey do. Look at that. It spiked right down there. Now it's turning around and starting to go back up. Oh, now look at our call that we sold. It's down 87. It's more sensitive. That's a lot more sensitive. Let's get rid of it while it's, well, let's just watch and see what it does. It's fun to see what it does. We get rid of it, then we don't have it to watch. You see how much more sensitive it is than the call that we bought. Oh, the call, I don't know, it hasn't changed at all. Maybe it's not updating. Probably is, so it's probably what it is. You think we're down? This is the third drive down. This is third drive. This looks like it could be the bottom. So that's the case. We don't want to be short. We got two shorts in here. Both of them are losing money. The put is a lot less sensitive. That seems like the short call is a lot more sensitive. It moves a lot more. Okay, there the market's kind of trying to fall again. Here we go. Now we're at 37. You can see options are for a little bit longer trading time frames. The spread was pretty wide too. Did you see the spread on this thing? See right there, that's the spread. The spread costs us $37.50, $25 just to get in. Costs us $37. So you're going to have to hang on to these a little bit longer to get past that $37 spread. And that's going to get out too. You're going to have to pay it on the way out. Oh, the market's starting to come back. It's trying again. I don't think we want to be short anymore. I think that let's liquidate our shorts. Take our losses. I think that maybe it won't let us out. Liquidate. Let's actually keep that one. I want to get rid of this one. Liquidate. Come on, baby. Let me out of there. Did I have two? I didn't realize I had two. How did I get two? All right. Well, we're only in with one now. So it took one off. I didn't know we had two. I think I put two on. I don't know how I did that. Well, the market just go dead sideways. Come on, do something. The last 15 minutes, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. The last 12 minutes has done nothing but go sideways. Look at all the topping and bottoming tails on this thing. What a worthless piece of junk. Come on, you rotten S&P. Move for us one way or the other. Get off the pot. I don't care which way. We'll make more money if it goes down, though. Come on. It's trying to break right there. Breaking those yellow dots. That's the average true range. Right through there. So close below the average true range. It should continue to fall. All right. Yep. See our option, our long call that we put on up here, anticipating a break of this rally up here. It's losing. It's down 162 now. And our puts aren't making it. Our short positions aren't making anything either. They're not covering the losses on our long call. Of course, the market's not going to go down hard. It's just going to sit there and piddle around till the close. Come on. Do something. Well, there we go. Come on, baby Russell. Oh, no, this isn't Russell. Come on, baby S&P. There we go. There we're getting a little bit of a trend. There's a two bar trend. 2 bars. You think we can get a third? Come on, give us a third bar down. 48 seconds until the next bar. Hey, look, we just hit break even on our that's the call that we sold. Wait, it says we sold a put, sell a call. Did we sell a put? I didn't want to sell put. I want to buy a put. Sell. We sold a put. I didn't want to sell a put. What did I sell a put for? I want to buy a put. How did I make that mistake? Oh, geez. This whole time I've been thinking that I was short the market. Oh, my gosh. What a stupid mistake. Land sold a put instead of bought a put. All right. Well, Land made a big mistake, thinking we were making money on the way down with a bought put, and we didn't. We sold a put. So if the market goes down, you sell a put, you lose money. Not the brightest individual on the planet. Look at our call, losing $220, and our sold calls down here is not making it up for us. And I screwed up with the puts. Land. We'd have been making all kinds of money now if we'd had 2 puts on to the short side. Why did I make that mistake? Error on the field. S&P's flushing. So we got 2 calls. We sold 1 call and we bought a call. We bought a call in anticipation of the bounce right here, and then we just didn't liquidate it. We thought it might bounce off of here. And then I thought, well, we'll buy some puts in case it keeps going down. I didn't think we were going to buy a 2 either. Somehow I got in with 2. I thought I was only buying 1 put. And I ended up selling 2 puts. I don't know how I did that. Brain wasn't working very well today. Well, we're getting a nice push down. This option's making money now. We're up $62. 75. This thing's kicking in. Delta's starting to kick in our favor. This is the one that's hurting us right here, $237. Let's just watch and see what happens. Because if this turns around, and here's the idea, this thing comes down here a bit, we could take our profits off of the 75, and then it starts turning and going back up. We just start making more money. Ooh, look at this. We're down 100, 300 on this one. We're up 100 on that one. That's a nice little flush. Wish we'd have had our put options instead of long, instead of short put options. We should have had long put options. I don't know how I made that mistake. Kept thinking that they were options that we bought. Whew, look at it flush. What's the Q's doing? I don't have any money in. I don't have any real money in the S&P, but I do have a lot of real money in the Q's. Let's go see what Nasdaq's doing. Nasdaq Mini. I got a lot of money in this market to the short side. So if it's going down, I'm making money. Ooh, I'm making money today. Let's go see. Woo-hoo, Lance making money today. I got a lot of. I got $250,000 short on that market right there. Make money when it goes down. $250,000 to the short side on a QQQ. Real money. Not demo, not play money. $250,000 to the short side. And look at it drop for me. Look at that baby go. Ho, ho, ho. Where did you put your money in, Lan? Oh, I'd say right about here. And it's gone down like that. Am I doing well? Yep. Doing well so far. Let's come back and see how we're doing over here. Not so well. Not so well. Our call keeps losing. Okay, are we at the bottom of this? Can we take our profits off of this one and watch the market turn around and go back up? Nope, still flushing down. It's just a little insurance policy to the downside for our long position, I guess. I guess that's how it's turning out to be. So we're only down 175, really. We wouldn't be down anything at this point if we wouldn't have made the mistake on our put options. I don't know how I did that. I don't know how the heck I botched that up. I never make mistakes. Never. If you believe that. I got a bridge to sell you. How's everybody doing out there? While we're watching these markets flush like a toilet, you can say something. Say hello. I'm seeing Notafinga. He's out there saying hello. Kirk's there. How you doing, Kirk? John Gaisley. Nice to see you, John. You guys put your options on? Did you put some on with me? Follow through? What'd you guys put on? Did you actually get your put options put on properly and not make a mistake like I did? Woo, look at the market go. $15 minutes. Where should we take that off? Where should we take our $162 off in hopes of a reversal? Hope. Probably about where that red dot intercepts. See the dot? We got the yellow dots coming in here. We got the red dots coming in with an intercept here. At some point, they're going to intercept like this. Boy, my machine is so slow. There's a 15-minute bell. So that red dot's going to come in and intercept right down here somewhere. When it intercepts, that's where we'll take our profits on the short position, the 212 off, and then we'll let see if the call won't go back up. Whew. Come on, baby. Are we just going to flush all the way into the end of the day? We got 15 minutes to go. The bleeding stopped at about 175 bucks, it looks like. Of course, if it keeps going, it'll outpace it. But we got to have a reversal and have a little rally here. Now we're $400 down on our long call, $200 up on our short call. We're only down 175. Okay, how far did this thing go? Let's get rid of all these drawings. Delete, deleted. Let's take this and measuring tool. We'll go from this peak here to this pullback. And then it went from this peak down to that one. So we're at 61.8. That's the Fibonacci golden ratio. If it was to do the exact equal, if it fell from here and then the same distance would be down here at the 100%. So if it gets down into that region there, we could sell, take our profits from the short call, and then anticipate the market turning and going back up. And we'll make money back on this one. All we'd have to do is make $175 to be back to break even. So $175. Come on, slow poke. See, $175 would be $300, about right there at a delta 0.50. So we'd only have to come back to there, and then we'd be back to break even. Anything above that would be profit. Hard way to do it, but that's the way we're doing it. We're doing it the hard way. Oh, we got rid of our measuring stick. Where does that go? Gonna measure. Count and measure. There we go. 3 drive pattern. Okay. Let's see if that red dot's going to intercept. That's where we kind of want to. Oh, what's happening? Doesn't want to go down to 90. Come on, baby. Go down to 90. Get that right on there, Lan. Okay, we want to maximize our profit potential on this short position in anticipation of a reversal. Getting a little green bar. All right, let's come in here. Come on, buddy. Okay, let's liquidate that baby. Okay, we took our profits off on that one. Now what we got to do is we need to have this market rally. It might be a little premature. That red dot's still up there. We didn't get all the way down to 90. But I'm going to anticipate. We're going 10 minutes into the bell. Let's see if we can get a rally into the open or into the close. A lot of short players need to buy to get out of their short positions. Doesn't necessarily mean that they're buying to get in. They might be buying to get out. Okay. Now we screwed up our put options. So that's our $200 on that one. Where did our put options go? Well, how come our put options aren't in there? There's our $200 gain that we just took. I don't know what happened to those stupid put options. All right, come on, baby. Let's rally now. Now we're long the market. Put another one in, Land. Put another one in. You could put a contract in, but usually when I do that, it ends up, I don't. We could put a contract in right here and say if it does fall, we'll use a contract trail on the ATR. And then if it falls, then we just take the short position as an insurance to the short side. But we don't really want that to fail. That oftentimes doesn't work out well for me. But I do it anyway. It's like an insurance policy to the short side in case this thing turns and starts to flush out. There we go. Now we're coming back. Every penny it comes back is profit. Because remember, we got $200 in profit on the opposite side. We're down 300. So we need 175 to break even. We got our insurance policy down here. In case it does turn and just flush hard back down, then we'll take a short position on the market, which I don't really want to do. Now, these are probably just buyers getting out of the short positions. I don't think there's anybody in here. Not very many people 10 minutes before the market opens that are just like, hey, I think I want to get into the market long on the S&P. These are just buyers to close out their short positions. So this probably won't be much of a trend. But remember, we got 2 days left in this option. We could leave it overnight if we wanted to. Uh-oh. 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 Is it going to fill our short position? Uh-oh. Don't do it. Don't do it. Oh, we just filled our short position. So now we're short and long. Oh, now look, it's going to turn around and go back up. So now we're going to lose money at the same rate we're making money on this one. Actually, not even. We're going to lose money faster than we're making money on this one if the market keeps going up. So I say sometimes I don't like to do this because do it with contracts, and then if it doesn't go in your favor immediately, you got to get back out and you take another loss. Come on, baby. If you're going to go short, give me some money on it. At least give me some money. Don't just touch my order and then turn around and run off with all my money. At least give me something there. Where's your parachute? Stop laying. Do as I say, not as I do. We'll just put it right here above that red bar. If it comes back up there, we'll just get back out. Take a loss. We'll have to make it up with our long call. As I said, oftentimes when I get like this and I put these insurance policies in as a contract, they don't generally turn out very well for me. Sometimes they do, but usually they don't. Are you dumb thing going to just turn around and go back up again now? Just going to dilly-dally around back and forth, not going to go anywhere. That's why I like options, because they're soft contracts. So the market just decides to go sideways for a while. You just kind of sit on them. Okay, are you going to flush again? One up for every down. Long set of dots down. Long set of dots down. Short set of dots up. This thing should technically go down one more time. Come on, flush it down. Go down to our 130.9. Make us some money on the way down at least. Don't just sit there and do nothing. Markets can only do three things. They go up, they go down, they go sideways. The worst thing they can do is go sideways. Because we always pick direction up or down, right? And then when you pick sideways, you're like, well, I think the market will go sideways. That's when it has a tendency to take off and run on you. That's my kind of luck. Oh, I think you're just going to go sideways. So I put on a sideways strategy. And then the thing goes to the moon. There we go. There we go. There we go. Break it, break it, break it, break it. Go ahead. You can do it. Break it. Break the little red dots and stay down there. Stay down there. Stay down there. Come on, everybody wants to sell out right now. The market's 5 minutes to the bell. Sell, sell, sell. I can hear them out there. Sell, sell. Nope, now they're buying it back. Buying it back. Can you believe that? Sell, sell, sell. Land, land, land. Bad boys, what you gonna do when they come for you? Come on. 4 minutes till the bell rings. Flush it out. Flush it, flush it. Whoosh. Whoosh. Should we pull out the big guns? Go down, go down, go down, go down. It's the best I got for you guys. Fall, baby, fall. Fall, baby, fall. This is power, man. This guy's powerful. This dude carries a lot of weight. Black magic makes the market fall. Come on, buddy. Get off the pot. Get off the pot. There we go. There we go. Good job. Pull the pin out. Pull the pin out. Ha! 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 There's the power of voodoo science. Okay, keep her going, buddy. Keep her going. Keep her down. Keep her down. There's if we could get $175, we'd get our money back. We could do that. We could come in here and go like this. We'll go add an OCO. We'll put this at 175 because that's about where our break even is. And then that thing would take our money back, and then we would have, let's see. Oh, look, we can get more than that. Oh, that's about 175 right there. If we could take 175 out of the market, that would give us, there we go. Now that was basically our drawdown on that long call that we just hung on to forever, right? We could kill this. So now our call, we've taken enough profit out of the two markets to cover the distance between our call. Now, if the call keeps, if the market keeps falling, we got to have our call. Our call needs to turn around. Close position. There they are, 100. So we're down 230. Oh, wait, 2,375 minus. We're up 237. Oh, but our call is down 500. We should have kept it. Look, it's still going down. But we got our 175, which was our loss at that point, wasn't it? Look at this. What is wrong with my computer? I give up. What the heck is going on with my computer? Out of memory. Look at my memory scope. What the heck is going on here? Oh, you know what? It says that this thing here is taking up a lot of memory too. Kill that. Well, the market's just closed. Well, that helped a little bit with memory. I don't know. Everything's froze up. Still moving over here, but that window's, oh, there it's coming back. My poor little computer. Trying to, I don't know. Yeah, buy me a new computer. Well, 175, 200, 100 on the options that we screwed up because we sold a put instead of buying a. Oh, look, we sold a put, we bought a put. Why did we do that? That's not what I intended. Anyway, I don't think that's what I intended. So we made 200, 175. We still got our long call. It's down 487. And the market's still flushing down. Well, the market's closed now. This is the after hours stuff. We're going to hang on. If we hang on to this, the max we can lose is 2,400. Not that we want to lose 2,400, but that's the max we could lose. If the market turned around and started to go back up tomorrow morning, we would gain on that. We could. But Lan, what if it goes down some more tomorrow? Well, then we lose some more. But what if it goes up? Then we'd make some more. And we can't lose any more than the premium we got in there. You could buy a little put option, lock it in there in case it does go down. It would lock it, but then you'd lose the premium on the put option if it went up. So we went into a 2-minute, and we can't buy it now. The market's closed. So we could buy a put tomorrow morning. How much would a put cost? I hit the button. It's just my computer is, I'm looking at the memory thing and I'm clear out of memory. I don't know where the memory went. Google Chrome, it says, is taking all the memory. The only thing I got on Google Chrome is the projection tool that projects to YouTube. Oh, look at it keep going down. Now we're down 560 on that option. We're going to keep that. Let's just keep it overnight. I don't know. If you guys got a call option on there at the same time, maybe you got rid of yours. You're smart enough to get rid of it. When it broke that low right there, we should have just dumped it. That was the plan. And then I was like, well, let's just hang on it. Let's just hang on to it and see what it does. We said when it breaks this low, if it breaks that low, then we need to get rid of that call option. We were just putting the call option in there in case it was going to turn and bounce for us and go up. And we thought maybe right there it's going to go up. So we put that little call option on there. And then we said, well, if it breaks that, boy, we're going to get out. And then we never did. We just put short positions on instead. Our first plan was a better plan. Now we're down 575. That market just keeps flushing. Although I don't feel bad. Got real money on the short side. This is just demo account stuff. Just playing. But this one here, let's go see how. Oh, look at this. Land's making all kinds of money today. $250,000 to the short side right here. Oh, look at that 3-drive pattern. Beautiful. Drive 1, counter trend. Drive 2, counter trend. Drive 3, long drive 3. All the way into Land's pocket. All right, guys, I guess we played enough. I'm going to leave that little option on there just for fun. We'll see what it does, see if we can't get a rally out of it. What we can do is we can come in here and we can say liquidate the option. We'll see if it'll let us do it after hours. We're going to come in here and put a limit order on there. And we're going to say if you receive, and we're going to put this back up to, what did we pay? 2,412. So we're going to put it 2,000. We'll put that back up there to 2,412. Or let's go a little bit above 412. For just to cover our spread, 2,425. So if it comes back and just gives us our money back, we'll just take it off the table, and then we'll make the money from what we made on our other options, right? On other trades. So that would just be if we got a little bit of a rally in the morning and the market came back enough to just give us back 2,412, which actually we would don't even need that just to get back to break even. We only need. We're down 500, but we're up. How much are we up? Closed. Oh, we're up 237. So 237. We really only need $250 and we'd be back to break even. So let's leave it there. That'd give us $250 in profit. So let's go ahead and place that order. And that's going to be a limit order, which is a contingency order, which is just going to stay active even though we turn the computer off, because that gets sent down to the exchange. Now we got an order that's pending that says, hey, if you make $250, take it off. I mean, we can't lose any more than $2,412 or another $1,800. If the market just keeps flushing to the toilet, then $1,800 is our max loss. But if it turns around and comes back just a couple $100, $500, then we'll take it off and make some money. We could lower it and just say to break even, which would be another $250 down. So it'd be $2,200. That would be break even. We could do that, and then we'd just be break even. But let's see if we can make some money. Ooh, it's still going down. Man, look at that market flushing in the after hours. Man, Land's making money. All right, guys, I'm going to let you go. That was a fun little day. Too bad we didn't have a profit today. We'll see if it doesn't come back for us, though. 237.50 close, 650 open. We're going to see if we can't get it to come back, and then we'll take our profits off and lock in some profits. All right, guys, we'll see you later. We'll check in with you and see how this does. You guys put this on yourself and watch it, see if it works. It's how you try and mitigate losses, I guess. Man, look at that market flush. All right, we'll see you later.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.